The Japanese yen has just plunged to a staggering 40-year low, sending shockwaves through global markets. With the producer price index soaring to an eye-popping 7.1% and the Bank of Japan aggressively cutting its balance sheet by $146 billion, we stand at a historic crossroads. By the end of this video, you'll be equipped to understand the exact triggers for a potential Ministry of Finance intervention and the looming repatriation risk that could reshape global liquidity. So, why is this moment so pivotal? We are witnessing the largest quarterly drop in the Bank of Japan's assets since the onset of quantitative tightening in August 2024. For decades, the BOJ was the last bastion of ultra-easy money in the world. Now, that anchor is being lifted. With the yen at a 40-year low and producer price inflation at a decade high, the government's hand is being forced, signaling a shift away from the era of cheap Japan into a tumultuous phase of policy normalization. Let's dive into the hard data from Q2 2026. The BOJ's total assets have plummeted by $146 billion, bringing its balance sheet down to $3.97 trillion, the lowest level since early 2020. Notably, JGB holdings fell by $78 billion. Meanwhile, June's Producer Price Index, or PPI, exceeded expectations, hitting 7.1% against an estimate of 6.8%. This persistent inflation, coupled with the central bank offloading $74 million in equity ETFs and JREITS, confirms that the era of massive liquidity support is officially over. On social media, real-time reactions are reaching a fever pitch. Traders are reporting sudden full-handle drops in US dollar to Japanese yen, speculating whether the Ministry of Finance has already initiated stealth interventions. One market participant noted a rapid 150 to 300 pip move, cautioning everyone to stay alert for an official statement from the ministry. The prevailing sentiment among financial experts on X is that we are in a danger zone where further yen weakness could trigger a staggering 200 to 300 pip corrective drop in just minutes. A crucial development has surfaced in political circles. Influential figure Katayama has signaled that the GPIF, the world's largest pension fund, should start repatriating capital. This repatriation risk could spell disaster for global risk assets. If Japan's domestic funds execute a large-scale carry trade unwind, the liquidity that has sustained global markets for years might just evaporate, triggering a violent repricing of assets from New York to London. The equity markets are feeling the pressure of these policy shifts. Traditionally, a weak yen has bolstered the Nikkei, but now, the surge in PPI to 7.1% creates a cost-push inflation nightmare for domestic sectors. Additionally, the BOJ's sale of $74 million in equity ETFs and JREITS indicates the withdrawal of the BOJ put that has propped up Japanese stocks for years. Investors are now shifting their focus from broad index exposure to sectors that can withstand higher interest rates and a potentially stronger yen. This isn't just a story confined to Japan, it has significant global ramifications. The yen's sharp decline to 40-year lows has sparked concerns about carry trade unwinding worldwide. If the Ministry of Finance steps in for its third intervention this year, we could witness a substantial shift in global risk sentiment. Traders now have a clear if-then checklist. If US dollar to Japanese yen breaches certain volatility thresholds, the MOF will act, potentially triggering an immediate 200 pip drop that could ripple through other currency pairs and even impact US Treasury yields. For individual investors, the focus must now be on risk management. We find ourselves in a regime where domestic fund flows, especially repatriation from the GPIF, could override traditional macro trends. Keep a close eye on the PPI data and BOJ asset levels. It's wise to avoid over-leveraged positions in yen crosses. With the market anticipating an intervention, we are in a high-volatility environment where waiting for the statement is a more prudent strategy than attempting to preempt the BOJ's next move. Looking ahead, we can identify three primary scenarios. In the base scenario, US dollar to Japanese yen remains volatile near its 40-year lows until the BOJ confirms a further rate hike in Q3, leading to gradual stabilization. The bullish scenario for the yen involves a coordinated MOF intervention alongside a GPIF repatriation signal, potentially causing a rapid 500 pip correction. On the flip side, the bearish scenario unfolds if PPI stays above 7% while the BOJ pauses QD, which could push the yen into uncharted territory beyond current lows, triggering a global liquidity crisis. To summarize, we have seen the BOJ's record $146 billion QD, the surprising 7.1% PPI, and the yen's historic low creating a perfect storm. Keep an eye out for the MOF intervention signal. This is the market's most critical if then trigger right now. If you found this deep dive valuable, please subscribe and hit the like button. What are your thoughts? Will the MOF intervene this week? Share your opinions in the comments below.